Microsoft shareholders reject Bitcoin, a sign of the times? The world of finance is buzzing. Just this week, Microsoft shareholders voted against a proposal to invest in Bitcoin. This decision is making headlines, and for good reason. It suggests a potential rift between generations when it comes to investing. Are older investors missing out on the crypto boom, or are they right to be cautious? It's no secret that Bitcoin and other cryptocurrencies have exploded in popularity. But this vote shows that not everyone is sold on the idea. Microsoft's board, influenced by industry veterans like Bill Gates, recommended against the Bitcoin investment. They argue that Bitcoin is already factored into their existing financial strategy. This cautious approach stands in stark contrast to the enthusiasm of many younger investors. The situation raises a lot of questions. Is this a sign that older investors are out of touch? Are they failing to understand the potential of this new asset class? Or are they simply being prudent in a volatile market? The answers are complex and point to a larger trend, a growing generational divide in how we think about money and investment. This is more than just a disagreement about Bitcoin, it's about how different generations view risk, technology, and the future of finance. And it's a conversation that's only going to get more heated as the world continues to evolve at breakneck speed. The Microsoft vote highlights a growing trend. Older and younger generations often disagree about investing. This is especially true when it comes to cryptocurrencies like Bitcoin. Older investors, many of whom came of age in a time of traditional markets and stable assets, tend to be more risk-averse. They've seen markets crash and burn. They understand the importance of diversification and long-term strategies. Younger generations, on the other hand, have grown up in a digital world. They're comfortable with volatility and risk. They see crypto as a way to potentially get ahead in a system they often view as rigged against them. Platforms like Robinhood have made it easier than ever for young people to invest in crypto. This has fueled a surge in interest and activity. This generational divide isn't just about risk tolerance, it's also about trust. Older investors often place their faith in established institutions and traditional assets. Younger generations are more likely to distrust authority and embrace new technologies. They see crypto as a way to opt out of a system they view as unfair or outdated. The Microsoft vote is a perfect example of this divide in action. The older generation, represented by the board, is taking a cautious approach. They're sticking with what they know. Meanwhile, many younger investors see this as a missed opportunity. They believe in the potential of crypto to disrupt the financial system. This difference in perspective is likely to continue shaping the future of investing for years to come. Let's be clear, not all older investors are skeptical of crypto, and not all young people are rushing to buy Bitcoin. But there's a clear generational trend at play here. Older generations tend to be more cautious about new technologies, especially when it comes to their money. This caution isn't necessarily a bad thing. It's often rooted in experience and a deep understanding of how markets work. Older investors have seen it all. They've witnessed the dot-com bubble burst. They remember the 2008 financial crisis. These experiences have taught them the importance of due diligence and a long-term perspective. They're less likely to get caught up in hype, and more likely to ask tough questions before investing. When it comes to crypto, older investors see reasons for concern. The technology is complex and still evolving. The market is highly volatile and prone to manipulation, and the regulatory landscape is uncertain. These factors make crypto a risky investment, especially for those who are nearing retirement or depend on their investments for income. This doesn't mean older investors are against innovation. Many are actively exploring blockchain technology and its potential applications, but they're doing so with a healthy dose of skepticism and a focus on minimizing risk. In the end, their cautious approach may serve them well in the long run. The rise of online trading platforms like Robinhood has been a game changer. These platforms have democratized investing, making it easier than ever for ordinary people to buy and sell stocks, options, and yes, even cryptocurrencies. This has been a boon for younger investors, who are often more comfortable with technology and more willing to take risks. Robinhood and its competitors have made investing more accessible and engaging. They've stripped away the barriers to entry and made it possible for anyone with a smartphone to become a trader. This has led to a surge in retail investing, with young people leading the charge. While this increased access to investing is generally a positive development, it also comes with risks. Robinhood has been criticized for gamifying investing, making it feel more like a video game than a serious financial decision. This can lead to impulsive trading and poor decision-making, especially among inexperienced investors. Despite these concerns, there's no doubt that Robinhood and similar platforms are here to stay. They've tapped into a desire among young people to take control of their finances and participate in the markets, and they've played a key role in driving the adoption of cryptocurrencies among younger generations. As these platforms continue to evolve, it will be interesting to see how they shape the future of investing and whether they can bridge the generational divide in finance.